In the year 2000, this was one of the most admired companies in America, Enron. For 6 years in a row, Fortune magazine called it the most innovative company in the country. Its stock soared past $90 a share. Wall Street loved it. Analysts who doubted it were laughed at. Enron had started as a boring gas pipeline company, but it reinvented itself into a high-tech trading giant that seemed to make money out of thin air. Its leaders were treated like geniuses. Bankers lined up to do deals. Employees poured their savings into the stock, certain it would only ever go up. There was just one problem. Almost none of it was real. Behind the gleaming tower and the soaring chart, Enron was hiding one of the biggest accounting frauds in history. And when the truth finally came out, it did not just wipe out the company. It destroyed the life savings of thousands of ordinary people, sent executives to prison, and took down one of the largest accounting firms in the world. So how did the smartest company in America turn out to be a lie? Let's pull back the curtain. The first trick was an accounting method called mark-to-market. Normally, if you sign a deal that will pay you over 10 years, you count the money as it actually comes in. Enron flipped that around. The moment it signed a contract, it booked all the future profits it imagined that deal might make. Right now, today, deals that had barely started, or that might never make a cent, were recorded as instant profit. On paper, Enron looked wildly profitable. In reality, the cash was not there. But booking fake profits creates a second problem. The real costs and the real debt have to go somewhere. So Enron's chief financial officer, Andrew Fastow, built a maze of secret side companies known as special purpose entities. Enron quietly shoved its debt and its failing assets into these off-the-books partnerships, so they would never appear on the main balance sheet. The structure was so tangled that almost no one could follow it. Fastow even ran some of these entities himself, on both sides of the same deal. To the public, Enron looked debt-free and unstoppable. Underneath, it was drowning. A few people saw it coming. An employee named Sharon Watkins wrote a warning that the company might implode in a wave of accounting scandals. Then, in August 2001, the CEO, Jeff Skilling, suddenly resigned after just 6 months in the job. Journalists started asking a simple question that no one could answer. How does Enron actually make money? Once people started looking, the cracks spread fast. The company was forced to admit its profits were overstated, and its debt was far bigger than anyone knew. The stock began to slide, then to crash. And at the accounting firm Arthur Andersen, which was supposed to be checking Enron's books, employees began frantically shredding documents. Trust evaporated. The stock that once traded above $90 collapsed to under $1. In December 2001, Enron filed for bankruptcy, the largest in American history at the time. The fallout was brutal. Around 20,000 employees lost their jobs. Many had their entire retirement savings tied up in Enron stock and watched it vanish to nothing. People who thought they were set for life were suddenly left with empty accounts. Arthur Andersen, an 85,000-person firm, was convicted of obstruction and effectively destroyed. Then came the trials. CEO Jeff Skilling was convicted and sentenced to 24 years in prison. The founder, Ken Lay, was also convicted, but he died of a heart attack before sentencing, and his conviction was thrown out. Andrew Fastow, the man who built the hidden entities, cooperated with prosecutors and received 6 years. Some money was eventually recovered for victims, but it was a fraction of what they had lost. So how do you protect yourself from the next Enron? Watch for these 5 red flags. Number 1. Profits that look too good to be true. A chart that only ever goes up and never dips. Real businesses have bad quarters. Number 2. Nobody can clearly explain how the company actually makes its money. If it is too complex to understand, that is the point. Number 3. Debt and losses hidden off the books, inside deals and footnotes most people never read. Number 4. Insiders quietly selling their shares and leaving even while telling the public everything is fine. Number 5. The watchdogs are compromised when the auditors are too cozy with the company they are supposed to police. If you ever invest, protect yourself. Ask hard questions, read the footnotes, and never bet everything you own on a single company's stock. Enron's own employees learned that lesson the hardest way possible. If this breakdown helped you see through the hype, hit subscribe and the bell so you never miss the next story. Thanks for watching, and I will see you in the next one.